Today, we're diving into a fascinating topic: how money is created. It's a process that affects all of us, but not many people understand how it actually works. So, let's break it down. First, let's start with the basics. Money is essentially a medium of exchange that allows people to trade goods and services. But where does it come from? Who decides how much money should exist? Let's explore this step by step. The creation of money primarily involves two types of institutions: central banks, like the Federal Reserve in the US, and commercial banks. Central banks are responsible for controlling a country's money supply and monetary policy. They can create money in a few different ways. Firstly, they can print physical currency. However, in today's digital age, most money creation happens electronically. Central banks create digital money by purchasing financial assets or lending money to commercial banks. Now let's talk about commercial banks. When you deposit money into your bank account, the bank doesn't just store it in a vault. Instead, they use it to make loans to other customers. This process is known as fractional reserve banking. Banks are only required to keep a fraction of their deposits as reserves and can lend out the rest. When a bank makes a loan, it essentially creates new money. The borrower now has new money in their account, while the original depositor's balance remains unchanged. This process multiplies the amount of money in the economy. In summary, money is created through the combined actions of central and commercial banks. Central banks control the overall supply and inject money into the system, while commercial banks multiply this money through lending. This system allows for economic growth and development. However, it also needs to be carefully managed to prevent issues like inflation, where too much money chases too few goods, causing prices to rise. And that's a brief overview of how money is created.